Put it this way, I think the stocks have been trying to lead gold down. Many of the institutions, the big money out there, they're not gold bugs, right? They look at the last big spike in gold in 2011, recency bias, and they thought 2020 was a spike like that. So the stocks have been leading gold downwards. That's this divergence that we've seen between gold and the gold stocks. I think that's wrong. And I think this is the year they realize that's wrong and the gold stocks catch up with gold. What I told these people last year and what I still think lies ahead here in 2024. So yes, I think that we're looking at higher gold. I think we're looking at more than higher response in the equities.
Gold has experienced a remarkable ascent, surging 45% from $1,643.55 in September 2022 to a high of $2,390.35 on April 17, 2024, as per World Gold Council data. The recent uptick in gold prices is attributed to the weaker US dollar following the release of US Nonfarm Payrolls data, which fueled expectations of potential interest rate cuts by the Federal Reserve later this year. Despite recent market fluctuations, Lobo Tiggre, editor of IndependentSpeculator.com, maintains a bullish outlook on gold for 2024. Tiggre anticipates further increases in gold prices and positive performance in gold equities, driven by factors such as institutional recognition of the sector's strength and potential. The prospect of an easing cycle could buoy gold prices as it becomes a more affordable option for foreign buyers. Additionally, strong central bank purchases and demand from Asian markets are expected to support the precious metal soon. Geopolitical tensions and concerns about inflation also contribute to the appeal of gold as a safe haven asset. However, Tiggre acknowledges the uncertainty surrounding the motives of new buyers entering the gold sector. According to the China Gold Association, in 2023, gold bar and coin investments surged by 28%, while gold jewelry demand rose by 10%. Year to date, gold sales in China have increased by 6%. Tiggre underscores the significance of gold mining stocks in reflecting the metal's underlying value, particularly during market volatility periods. Join us as we delve into LoboTiggre's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
Last year, at this same event, uranium had been my top conviction trade for 2023. And I told these people, for 2024, it's going to be gold, but for the type of reasons that you just enumerated. And instead, we've seen this pop early on in the year for none of those reasons. I'm not sure that I would go so far as to say that the gold sector got on with it. I think we've had significant new buying in the space. I don't think it's just the central banks, because they were doing that, or they have been doing that for more than a year. They've been propping up gold in the face of headwinds. And suddenly this increased buying, I think, does indicate a new buyer. The good news is we have this new buyer. The bad news is we don't really understand who it is or what the motives are, which means we can't forecast the outcome. Did they stop buying this week? Was that $50 drop the end of that new buying? Is this the correction and now we go back to the trend before this new buying? I don't know. It could be. But to get to the nut of your question, the nuts and bolts, the nub of it, I meant, if that was a tailwind and it fades, it doesn't change the underlying thesis. What I told these people last year and what I still think lies ahead here in 2024. So yes, I think that we're looking at higher gold. I think we're looking at more than higher response in the equities. When all these people that have been, put it this way, I think the stocks have been trying to lead gold down. Many of the institutions, the big money out there, they're not gold bugs, right? They look at the last big spike in gold in 2011, recency bias, and they thought 2020 was a spike like that. So the stocks have been leading gold downwards. That's this divergence that we've seen between gold and the gold stocks. I think that's wrong. And I think this is the year they realize that's wrong and the gold stocks catch up with gold. So I think that's still ahead. That was my thesis. When I say last year, I mean last November, December, so not so long ago. I think that's still in play. The big hockey stick that we saw earlier this year was not based on my thesis. So all these people congratulating me on saying, oh yes, this is the year for gold. Well, great, but that not for the reasons that I gave, so I can't really claim to have been right. So it still remains to be seen if I'm right. I think I am. I think that will be clear this year. But now we're going into that from a much higher base. Like if we were going into that from $2,000 gold, and now we're going into it at 2300. Let's say it goes back to 22. That would be a pretty significant retreat. But 22, I mean, that's a fantastic place to go into a bull market that could easily add, easily 10, 20%, which takes us to new nominal records by far. And typically a gold bull will go up like this 50% or something like that. I don't even want to say the numbers out loud. It gets embarrassing. But you hear what I'm saying, right? The answer to your question is all the reasons I was bullish for gold are still on the table. They're still ahead. And we're going into it from a position of much greater strength. So it's pretty exciting. But anyway, social media is full of, oh my God, gold fell $50. What are we going to do? Is it time to jump out the windows yet? Gold bugs are only happy when gold is going up. Doesn't matter how high the gold dollar exchange ratio is or how much money the miners are making, as you just referred to. If gold isn't going up, something's wrong. It's manipulation, whatever. That's maybe part of the problem, is that we haven't been making as much money as we're supposed to be. The whole reason why we bother with these, to use Doug Casey's very technical definition, crappy mining stocks, is for leverage to the underlying minerals. And so if the metal goes up and your stocks are still in the doghouse, if not the circular file, right, then something's wrong. Why take the risk if you were better off just buying the metal? So I've kind of gone off the rails from your question here. Great start. I would agree. If gold corrects to $2,300, like what kind of disaster is that? The majors are reporting, right? And we're seeing beats on expectations. Okay, some guidance was low. I'm sure you've interviewed Rick Rule, and he's talked about what talent it took the mining industry to take vast increases in the price of gold to turn into negative free cash flow, right? So we're seeing a significant turnaround, and it's not just gold. To see it in the miners, in their margins, is material and important.
Tiggre sheds light on the skepticism prevailing among equity investors towards gold producers, highlighting their historical underperformance despite significant upticks in the price of gold. Gold miners, represented by the GDX ETF, have trailed behind gold prices over the past year, with a noticeable lag of over 19%. This trend is expected to persist due to delays in developing mining facilities and escalating production costs. The struggle of gold miners to match the earnings growth rate of the gold price, let alone surpass it, is a stark reality. For instance, Barrick Gold, one of the world's largest gold producers, has grappled with profitability over the last decade, despite an approximate 80% surge in the price of gold. This challenge has been mirrored in share prices as well. Tiggre underscores the imperative need for tangible improvements in the operational performance of gold mining companies to regain investor trust. The recent outperformance of expectations by the top 3 gold producers in Q1 is a promising development, hinting at a potential turnaround in the sector. Let's get back to the interview.
To quote our friend Rick Rule again, he, in that quip of his about how it took real talent to take a 7-fold increase in gold and turn it into consistently negative free cash flow. There's good reason for equities investors to be skeptical of the producers. They basically flubbed it last time, big time. So it's one thing if you're a speculator and just getting into gold stocks because you think gold's going up and the stocks will go up more. It's another thing if you're an investor allocating capital. Why would you do that in an industry that's famous for dropping the football at the crucial moment? So it's a kind of show me, don't tell me, I think. And the fact that we just had the top 3 gold producers beat in Q1, I think is very significant. It begins to answer this question. So the underperformance of the stocks, if you want to look at that as reasonable given the performance of the companies, is being addressed now by the performance. Maybe 1 quarter is not enough. Maybe it'll take next quarter as well. But it sure helps that right now we're seeing higher gold turn into higher margins. That's important. So let me be clear, dear audience. I'm not saying that the gold stocks are going to the moon tomorrow. I have written it as my view that what's happening now is necessary. It's part of what has to happen for the gold stocks to start performing as they should and have in the past. So I'm very encouraged to see what's happening right now as you and I speak. And as a stock picker, if I'm a generalist investor and I get a little bit bitten by the gold bug and I want to get into gold and I want leverage, so I want to buy some stocks, but I don't know anything about gold stocks. I do one of 2 things. I go to the biggest and well-known, so that's why we call these the go-to stocks. This is another Doug Caseyism. The most well-known names, it's where the money goes to when it first gets interested. But when Doug started talking about go-to stocks, the ETFs didn't exist. And so now they have this other choice of the ETFs. So I think that that first rush of generalist money goes straight to the ETFs and maybe to the top, most well-known gold miners, which doesn't necessarily mean the best, the most well-run, or the best free cash flow producing, right? It's the most well-known. So anybody who's new looks up gold miners, biggest gold miner, Newmont pops up. Does that make Newmont a great company? It's not my favorite, but it's going to be the number one Google result, right? So two things. One is, the generalist money will go there, but that doesn't necessarily mean that's the whole story. I think this is a stock picker's market. I think it matters how well a company performs. And if you look amongst the big three, one of them has done better than the others, and it's the one that has the most consistently better operations.
Like Eagle Mines.
I didn't say that, but it rhymes. Right? But so that's not rocket science. Like that's a better business. And I don't want to tout any one of these companies, but I think that matters, and it works for the whole space. I think the problem with the ETFs is you have a basket, and the basket is determined by this spreadsheet that has these certain criteria, and it's very hard to put important values in these criteria like political risk. How do you assign a political risk score for Brazil? Basket case country that just had a coup d'etat, that's easy to assign some kind of discount, but something in between like Brazil, how do you assign a score to that? But there is political risk, or Mexico. It's a well-known mining jurisdiction, but really has taken quite a turn for the worse recently. Has that really been priced in? And these ETF baskets, I really don't think account for these kinds of things. Anything about this, which is not our audience, but the generalist audience, maybe the ETFs are fine. But if you do have a clue, and you read, and you care about this stuff, and you see what's going on, I do think it's prudent to be a stock picker and pick the better, not necessarily the biggest or the most well-known.
The recent surge in gold prices highlights its appeal amidst economic uncertainty, while skepticism surrounds gold producers due to historical underperformance. Despite challenges, recent positive developments in the sector offer hope. How do you see these dynamics influencing investor sentiment moving forward? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.